Hello TrizzleMedia learners, and welcome to the first episode of our series on business accounting. In this episode, we will cover what accounting is, why it is important for any business, and what are some of the basic accounting principles that guide the practice of accounting. Let's begin. In the world of business, accounting reigns supreme. Often referred to as the language of business, accounting provides a systematic way of recording, measuring, and communicating financial information about economic activities. It's the backbone of any successful business, providing the necessary data that informs critical decisions, ensures legal compliance, and monitors progress over time. Now, the realm of accounting splits into two main branches: financial accounting and managerial accounting. Each branch serves a unique purpose and caters to a different audience. Financial accounting, for instance, focuses on crafting and presenting financial statements to external users. These users could be investors, creditors, or the general public, anyone outside of the business, really. The financial statements offer a snapshot of the business's financial health at a specific point in time, whether that's a year or a quarter. To ensure consistency, transparency, and comparability, financial accounting adheres to certain rules and standards like the Generally Accepted Accounting Principles, or GAAP in the United States, or the International Financial Reporting Standards, IFRS, in most other countries. Managerial accounting, conversely, caters to the internal users of a business. It provides managers and employees with the necessary information to plan, control, and evaluate business operations. Unlike financial accounting, managerial accounting does not have to follow a set of strict rules and standards. Instead, it's tailored to meet the individual needs and goals of a business. Reports from managerial accounting can include budgets, forecasts, variance analyses, product costing, break-even analyses, and other tools that support strategic and operational decision-making. Please click on the like button if you find this video helpful. Financial accounting is more than a good business standard. Compliance and internal auditors, shareholders and investment firms, and other external audience members of financial records use financial reports to make decisions, validate and control spending, and report business financial health. One of the use cases and importance of knowing the generally accepted accounting principles. Information, if a person works in finance and accounting, is to ensure the quality and accuracy of the financial statements that are prepared and presented to external users. Generally Accepted Accounting Principles provides a common framework and set of rules that guide how financial transactions and events should be recognized, measured, recorded, disclosed, and audited. By following Generally Accepted Accounting Principles, a person working in finance and accounting can ensure that the financial statements are consistent, comparable, and reliable across different businesses and industries, and that they reflect the true economic reality of the business. This can help to enhance the credibility and reputation of the business, and to attract and retain investors, creditors, regulators, and other stakeholders who rely on financial statements for decision-making. Another use case and importance of knowing the generally accepted accounting principles. Information, if a person works in finance and accounting, is to comply with the legal and tax regulations that apply to the business. Generally Accepted Accounting Principles is often based on or aligned with the laws and regulations that govern the financial reporting and taxation of businesses in different jurisdictions. By following Generally Accepted Accounting Principles, a person working in finance and accounting can ensure that the business meets its legal and tax obligations, and that it avoids any penalties, fines, audits, or lawsuits that may arise from non-compliance. This can help to protect the business from legal and financial risks, and to maintain good relationships with the authorities and the public. Accounting isn't just numbers and statements, it also operates based on a set of principles. These principles help maintain the integrity and reliability of accounting data. The entity principle, for example, maintains that a business is a separate entity from its owners. It ensures that the financial transactions of a business are recorded separately from those of its owners. The monetary unit principle states that only transactions that can be expressed in terms of money are recorded in accounting. This principle also assumes that the monetary unit is stable and unaffected by inflation or deflation. The time period principle allows businesses to divide their life into artificial time periods like months, quarters, or years. This principle enables the periodic reporting and comparison of a business's financial performance. The historical cost principle dictates that the assets and liabilities of a business should be recorded at their original cost. This principle ensures that accounting records are objective and reliable, as historical costs are verifiable and based on actual transactions. The revenue recognition principle, this principle states that revenue, which is the inflow of assets, or the reduction of liabilities from selling goods or services, should be recorded and reported when it is earned, not when it is received. Revenue is earned when the goods are delivered or the services are performed, and when there is a reasonable certainty of collection. The matching principle, this principle states that expenses, which are the outflow of assets or the increase of liabilities from consuming goods or services, should be recorded and reported in the same period as the revenues that they help generate. This principle ensures that the income statement reflects the true profitability of a business for a given period, by matching the revenues and expenses related to that period. Now, let's look at some examples of how these principles are applied in practice. Historical cost principle. Suppose a company buys a piece of land for $100,000 in 2010. In 2020, the market value of the land increases to $150,000, but the company does not sell it. According to the historical cost principle, the company should report the land on its balance sheet at its original cost of $100,000, not its current value of $150,000. Suppose a company purchases inventory for $50,000 in cash. The inventory is recorded as an asset on the balance sheet at its historical cost of $50,000. When the company sells the inventory for $60,000 on credit, the revenue is recorded on the income statement at its fair value of $60,000, and the inventory is reduced by its historical cost of $50,000. Revenue recognition principle. Suppose a company provides consulting services to a client for $10,000 in January 2020. The company sends an invoice to the client in February 2020 and receives the payment in March 2020. According to the revenue recognition principle, the company should record the revenue of $10,000 on its income statement in January 2020 when the services were performed, not in February or March when the invoice was sent or the payment was received. Suppose a company sells a subscription to its online platform for $120 for a year, starting from July 1st, 2020. The company receives the payment in advance on June 30th, 2020. According to the revenue recognition principle, the company should not record the entire revenue of $120 on its income statement in June 2020, when the payment was received, but rather recognize $10 of revenue each month from July 2020 to June 2021, when the service is delivered. The matching principle. Suppose a company pays $5,000 for rent in December 2020, for the period from January 1st, 2021, to March 31st, 2021. The company records the payment as a prepaid expense, which is an asset on the balance sheet, in December 2020. According to the matching principle, the company should not record the entire expense of $5,000 on its income statement in December 2020 when the payment was made, but rather recognize $1,667 of rent expense each month from January 2021 to March 2021, when the rent is incurred. Suppose a company pays its employees $20,000 for their work in January 2021. On February 15th, 2021, the company records the payment as wages payable, which is a liability on the balance sheet in January 2021. According to the matching principle, the company should record the entire expense of $20,000 on its income statement in January 2021, when the work was done, not in February 2021, when the payment was made. We hope these examples help you understand how the historical cost principle, the revenue recognition principle, and the matching principle work in accounting. In conclusion, accounting, whether financial or managerial, is a critical aspect of any business. It's the language that communicates the financial health of a business, guides decision-making, and ensures compliance with legal and tax regulations. It's a complex system, but with a fundamental understanding of its principles, anyone can begin to decode its messages. If you have any questions or comments, please leave them below, and we will try to answer them as soon as possible. Don't forget to subscribe to TrizzleMedia and click the notify button to get alerts when we release new videos on Monday, Thursday, and Saturday.